morning, everybody. My name is Amanda Holyoke. I am the committee officer for the Pensions Committee this morning. I'm obliged to let you know that this meeting is being live streamed and recorded. If any members of the public present have any concerns about this, please raise them now. So we come to the first item on the agenda, which is the election of chairman for the ensuing year. Are there any nominations, please?
I propose Councillor Tom Biggins. Sorry, Councillor Tom Biggins. Senior moment. I propose Councillor Tom Biggins as chairman of this committee. Seconded.
Okay, thank you. Are there any other nominations? No. Thank you very much, Councillor Biggins. The IT technician will just help you connect up to this screen. So that you can see what's on the screen behind you on here.
On there,
yeah.
Yeah. Oh, I see.
No, no, okay. You need to. Okay, we'll leave it then. We'll leave it then. Okay.
Okay, well, thank you very much indeed for electing me as chairman. Item 2 on the agenda, apologies and substitutions, please. I believe we have 2 apologies. We have apologies from Councillor Malcolm Smith and Councillor Ray Evans, and possibly Laura Hoskinson as well, and we don't have any substitutions. Moving on to item 3, appointment of vice chairman. I've had a telephone conversation with Councillor Malcolm Smith, and I would like to propose Councillor Malcolm Smith as the vice chairman of the committee.
I will second that nomination of Councillor Malcolm Smith.
Thank you very much. Are there any other nominations? No, in that case, well, Councillor Malcolm Smith is duly elected as vice chairman. Item 4, disclosure of pecuniary interests. Are there any disclosable interests? No? Very, very good. I just wondered at this stage if it would be helpful, particularly to the public watching us from the website, if we just took a moment to just go around the room and actually introduce ourselves. And I'm going to suggest maybe if we could start, please, maybe we ought to do it around the room. Maybe could we start with Eugene, and we'll work our way around the room.
I'm Jean Smith. I'm the pensioner representative on the committee.
I'm Simon Harris. I'm the councillor for one of the councillors for Cleveland Mortimer.
I'm Debbie Sharp. I'm the Pensions Administration Manager at Shropshire Council. Hello, I'm James Walton. I'm the Shropshire Council Executive Director of Resources, and I'm the Shropshire Pension Fund Administrator.
I'm Tom Biggins, Chair of the Pension Fund, and I'm a Shropshire Councillor for Whitchurch North.
Good morning, I'm Justin Bridges. I'm the Head of Treasury and Pensions at Shropshire Council.
I'm Brian Williams. I represent a division called the Meres, which is between Ellesmere and Wem. And I'm also the chairman of the council's audit committee.
My name is Councillor Roger Evans. I represent what's called the Longdon division, which is just to the southwest on the outskirts of Shrewsbury.
Byron?
Sorry, my name's Byron Cook. I'm with Telford and Wrekin Council, and I'm an employee representative.
Okay, thank you.
Good morning, I'm Dave Wright. I'm a pension board member and I'm here as an observer today.
Thank you very much. We also have a number of advisors online as well. I wonder if they would just like to introduce themselves, please.
Good morning, everyone. I'm Roger Barclay, Independent Advisor.
Good morning, Emily Maguire, Investment Advisor from Aon.
And I'm with Aon as well, Louis Paul Hill, Investment Advisor from Aon as well.
Good morning, I'm Grant Patterson from Grant Thornton, and I'm the Pension Funds and also the Council's Engagement Lead and External Auditor.
Thank you all very much indeed. This is actually a hybrid meeting. It's great to actually be physically present again in a physical meeting, although it is a hybrid meeting because we have a live stream as well to our website. I'd just like to take this opportunity to welcome 2 new members to the committee. Roger Evans, I know, has already served on the committee previously, and it's great to have you back, Roger. And I'd also like to welcome Simon Harris, who is a new member to this committee and indeed a new member to the council. At the end of the last meeting, we said farewell to one of our members, Michael Wood. I hadn't realised that another very valued member of this committee was also leaving the council, and that was Chris Mellings. And I would just like to record this committee's thanks to Chris. And I did several weeks ago actually write on behalf of this committee to Chris to thank you for the many years of service that he's given to this committee. Roger.
Thank you, Chairman. I'd like to be associated with that. I think that all members would of the council and the committee. I also wanted to make a comment, and I'm not expecting any comment from yourself. In that, I'd just like it registered that Shropshire Council have refused to supply me with a set of papers for today.
Yeah.
I'm having to use a computer, which I'm very unhappy with. And I know there's nothing you can do, but I'd like it registered about my total unhappiness at that. Thank you.
No, point very well made. Moving on to item 5, the minutes of the previous meeting. We all have had those circulated, and I would like to move that they are signed as a true and correct record. May I have a seconder, please?
Yes, I was present at that meeting and will second them.
Okay, thank you very much, Brian. We'll now move on to public questions, and I believe we have 3 public questions. We'll use the same format that we have done recently, and that is I'll ask Justin to read out each question, and James will give the response to each question. Roger.
In previous meetings, public questions have been circulated before the meeting. Will we have copies of those questions and the answers supplied as soon as possible?
Yes, we will do that. In fact, the answers go straight on our website anyway, but we can make sure that you get it. All members get an email of the questions and the responses. Yeah. I think that's very important. The first question is from Chris Welsh, please.
Thank you, Chair. A publicly available FOI gives details of the pension fund's investments in 4 fossil fuel companies between May 2019 and the end of October 2020. The 4 companies are Anglo American, BHP Group, BP and Shell. In May 2019, the fund's investments in these 4 companies amounted to 25.05 million. By the end of October 2020, they amounted to just 5.47 million. The FOI replied detailed this as an overall profit and loss drop of 7.54 million. By comparison, the total profit and loss drop of the entire portfolio was 18.13 million in the same time period, meaning that these 4 companies accounted for 41.5% of the fund's losses from May 2019 to October 2020. As Pension Committee members, you have been sent a summary of the recent Divest UK report, which includes the finding that over 1.75 billion has been wiped from UK council pension funds due to crashing oil investments over the past 3 years. Shropshire County Pension Fund has experienced its own oil crash in those 3 years. Shell and BP combined investments as at 31st of March 2018 was 25.33 million. By 30th of October 2020, it was 3.62 million. That is a reduction of 86%. It is now well past the Shropshire County Pension Fund to drop fossil fuel company stocks, both for the climate and for the fund's future valuation. You are asked by the council to commit to divesting within 3 years in July 2020, but you say you will not make a decision until December 2021. What assessment has the committee made of the risks of delaying the decision on divestment?
And the response, please.
Thank you, Chair. Response is the Pension Committee is currently undertaking an extensive piece of work around this, and the timelines for making decisions have already been made publicly available.
Okay, thank you. And question 2 from Lindsay Short, please.
Thank you, Chair. Can the Pension Committee please comment individually on this quote from the head of LGPS Central, Mike Weston? There is a unifying belief among our partner funds that there is no point in generating great investment returns if when people retire decades in the future, they have an ugly world to live in. And equally, it's no point creating a great world if the retirees don't have a pension to enjoy it with. So we have to balance these 2 elements. Our view is that investing responsibly in sustainable industries actually leads to a better world and higher investment returns.
Thank you very much.
Can the Pension Committee outline their plans to stay within the Paris Agreement and divest from fossil fuels and invest in sustainable industries, rather than continuing to support industries that cause and have full understanding of the environmental, social, financial hardships and damage that they cause? Creating the ugly world is rather an understatement, as it is well documented that these industries are destroying the planet. It does not seem unreasonable for the committee to state how they will follow the lead and demand investment in sustainable industries for a better return and better environmental outcome. There is of course every reason to save the planet and at the same time have a healthy pension. There is no point harming the planet on which we live, leaving nothing for future inhabitants to enjoy.
Thank you. And the response, please.
Thank you, Chair. The Pensions Committee would not wish to underplay the importance of this question in any way, but this question is very similar to previous questions we have received and answered. The status of the significant progress made to date following the Council's motion and the timeline for future decisions, statements made by the Chair, previous public questions submitted and the responses provided, and specific presentations on all of the issues raised in this question can be found by following the link to all the Pension Committee meetings on the Council's website.
Thank you. And question 3, please, from Joanna Blackman.
Chair. In the last couple of weeks, all members of the Pensions Committee should have received a copy of the UK Divest report produced by Friends of the Earth and Platform. Please could members of the Pensions Committee confirm whether they have indeed received a copy of the report. The report quotes research which demonstrates and quantifies current impacts of burning fossil fuels. For example, in 2018 alone, the burning of fossil fuels caused more deaths than tobacco smoking and malaria combined, often through heart disease and respiratory ailments. Do these findings about the current harm caused by fossil fuels and/or other conclusions of the report raise concerns for committee members about their continuing strategy of investing in and engaging with fossil fuel companies?
Okay, thank you. And the response, please.
Thank you, Chair. And to confirm, I can confirm that members of the Pension Committee have indeed received a copy of this report. Thank you.
Okay, thank you very much. We move on now to item 7, the Shropshire Pension Fund Audit Plan. And this is a report from Grant Thornton, and Mr. Grant Patterson will be presenting this to us. So over to you, please, Grant.
Thank you, Chair. And good morning, everybody. And thanks for the opportunity to present our audit plan. If I ask you to look at page 7, I think in the public pack, which contains the first page I'm going to talk to around the key matters. So our audit plan effectively brings together our overall audit approach to auditing the pension fund financial statements for this year. I suppose in broad aspects, the overall approach for those members who have been on the committee before is similar to the approach we've undertaken in prior years. But clearly what we do is each year we reassess the risks. And on page 7, we've just highlighted some of the factors we've considered in respect of sort of looking at the risk profile of the fund for this year and some of the elements that are impacting upon you. So clearly there's elements around the sort of pension fund development. We can see that your overall position has grown. The investment size has grown over the year, and the value of the fund is just over 2 billion towards the year end. You're still going through looking at guaranteed minimum pensions, both the equalisation and indexation. The exit cap legislation has been disapplied. I think the assumption is it will return at some point, so that's probably not a risk for this audit, but it may be something for the administration side going forward. And clearly the government is implications of McLeod, and there are remedies applied to some of the civil service schemes, and I think the remedy for the LGPS and is still the final outcome is still awaited, but it is coming through. And probably the biggest thing to draw your attention to probably in the changes for this year is in terms of the way our audit is working, is there are new or revised auditing standards around estimates. Now clearly from a pension fund perspective, a lot of the fund valuations at year end are estimates. So the impact of this will be, as I say, page 7 in our plan, where we'll be doing sort of, I suppose, enhanced or more greater challenge of the estimates within the financial statements. We've always done that. What's happening now is we need to document that in a slightly different way, gain more assurance from management's assumptions within that. And I suppose from the pension fund, you do place reliance upon investment managers in respect of helping you to value those assets, about how you've gone about getting assurance around those. We have highlighted at the bottom of the plan the impact of COVID-19. I'm sure you'll hear later from your advisors and experts in relation to that whilst it does have a continuing impact, I think from the audit perspective, certainly last year, where you had material uncertainties disclosed in your financial statements around property. I think we are seeing property markets free up, and if funds were gated last year, we're seeing more that they're ungated. So I don't think there's going to be as significant an issue for us this year as your auditors in terms of valuation of assets, but we will continue to look at that as we go forward. I suppose that's it of the key context areas. If I move you on to page 8 in respect of how that then travels through in terms of the headlines, in terms of significant risks. In terms of significant risks we've identified, picking up on that, the revenue recognition cycle, that's your income effectively. We're satisfied, the main source of income are contributions, investment income. Those are relatively straightforward to audit. Therefore, the presumed significant risk within auditing standards is around that, as we have rebutted. And under practice note 10, we also need to consider from a public sector perspective where there's impact upon expenditure. Now, clearly, I think as a pension fund, your main area of expenditure is the benefits payable to pensions. And again, that's set by statute in the statutory framework. So I think the risk of there being a sort of material misstatement due to fraud is low, therefore we've also rebutted that. The one significant risk we can't rebut is around management override of controls. We have to assume that that will happen. I have no reason to believe that it will happen. And the way that we address that primarily is through looking at journals, and journals are where the management can move numbers around within the financial statements to put it in a very simplistic terms. And therefore that's the primary element. If someone was trying to defraud the fund in some way or misreport, that would be the way they would do it. Therefore our audit focuses on that. And then you probably won't be surprised as a pension committee that in terms of, I suppose, evaluation of your assets, those that we consider to be I suppose at higher risk in material misstatement are the level 3 assets. So those are the ones where there aren't regularly quoted prices available for you, and as well, you're almost like reliant upon experts to give you those valuations, and therefore we do quote that as a significant risk. In terms of when we are doing our audit, what's materiality? In terms of materiality, the figure we look at, or we determined this year is £20 million, and that's approximately 1% of your net assets. And that was at February 2021, but I think that's consistent with what the outturn for this year will be. And the items where we have to report back to you is where we find misstatements over £1 million. We will record all misstatements, but those are the ones we specifically will be reporting to you. In terms of, I suppose, audit logistics, we did some interim work back in April, and we're just now waiting on the production of the financial statements, and we're due to be on site next month to carry out the final audit. Just quickly going through it, on pages 9 and 10, there's a bit more detail around the significant risks I've just summarised there, so I don't propose to go into more detail on that. On page 11 of your pack, which is page 7 of ours, that's where we begin the bit more detail around accounting estimates, the standard we have to follow. And basically that gives you more a fleshing of the bones about how the work we need to undertake, and it will be more rigorous this year and more challenging and more documentation. And we've already begun to have conversations with the finance team around this. And if members can remember, for the last audit committee, we brought our informing the risk assessment, and within that we did cover off some of the judgments around accounting estimates. So that's part of our work that we'll be carrying out on that, and we will be focusing on results of that around level 2 and level 3 investments. I think probably if I take you to page 13 or page 9 of ours, I suppose what is important, I suppose, from your role as a pensions committee is understanding those assumptions when you do receive the financial statements, and being satisfied that the valuations are appropriate. On page 10 of our report, page 14 of the pack, just highlighting there other matters, which, being a public sector audit body, what people are allowed to object to your accounts, etc. And we're also looking at going concern there. We will be applying, there's an audited practice note 10 for the public sector as an adaptation of the adaptation of going concern basis for public sector bodies. So we will be looking at that. Essentially that moves the focus now onto service provision, and I think generally that reduces the risk for us as your auditors, because the fund will be taken over by somebody else even if it ceases to operate in technical terms. So no issues around going concern in that respect that I'm anticipating, but just to say there's slight change in focus of the way we assess that. Page 11 of our report, page 15 just summarises materiality that, as I've said, and on page 12 is the overall timeline for the audit. One thing to bring to your attention, I think, picking on that on page 17, are the audit fees. I'm sure members have picked up there is a significant increase from proposed increase from last year. These haven't been finalised yet. They are still subject to public sector audit appointments review. This does in a way pick up on discussions we've been having with the pension fund and the administrating authority over the years, about the last couple of years, in terms of the expectations of auditors. And particularly picking up here the additional work we did last year, which flows into this year, and those additional items that I recommended, I said earlier, around estimation, the ISA 540 that we need to undertake. And this also does link in, I suppose, in the way to the Redmond review of local government, in terms of the expectations of public sector auditors. And the government has made, I suppose, a pot of money available for the anticipated increased audit risk, although I think it has only just finished its consultation on how that will be allocated, and part of that will be to support, I suppose, the additional the rigour that's expected in public sector audit. So we've highlighted there the proposed fee increases as part of that. And then finally, just to confirm that we do remain independent of the pension fund under the ethical standards. And the only additional piece of work we do for you is we do receive as auditors requests from other auditors around assurances around IS 19 elements. So that's the additional piece of work that we do, and we're satisfied that we remain independent of the fund. So I was going to stop there, Chair, and happily take questions.
Yes, are there any questions, please, members? No, well, I've just got one question. That's you. Sorry, we've got some feedback a bit. Level 3 investments, presumably that's property, but particularly liquid growth investments, things like private equity and infrastructure investments.
Yes, Chair. I mean, primarily private equity. Well, this is exactly what you said there. Infrastructure investments. It depends on the nature of the vehicles that the investments are in. Generally, you don't have directly hold property, and that would normally classify as level 3. But I think you do it through pooled investment vehicles primarily. So yes, and I suppose our approach will depend upon the nature of those investments and how they're held. Normally, your investment managers will use sort of private equity based valuation basis, in line with international standards. Wherever possible, we go back to, if there are available, audited accounts in the sub funds, etc., to give ourselves assurance. So, but yes, level 3 is those harder to value investments effectively.
Any other questions, Brian? No. Sorry, the screen's in the way. I just no.
No, I think we accept this as an interim report. I'm more concerned to see what comes out of the audit findings report, the final report, which we'll get at our next pension fund committee.
Brian, can you change your microphone?
Is that on now? Yeah. My comment was that this is by nature a holding report or an interim report, as stated, and I think I'd be more concerned to read the final report, Grant, when you make it to us and we see it at our 17th of September meeting. There doesn't seem to be anything on the interim report that I find of concern at present, and hopefully that will be the case when we get the final report. Thank you, Chairman.
Okay, thank you very much, and thank you also, Grant, and we look forward to seeing you again in September.
Okay, thank you, Chair.
Thank you. We will now move on to item 8, and this is the recap on our investment strategy decisions and implementation update, and this will be presented to us by Louis, please.
Tom, am I right that everybody has a copy of the presentation in front of them, so I don't need to show it on the screen?
No, we have no copy.
We need to see it on the screen.
We need to see it on the screen, please.
Okay,
yes.
I will attempt to share it. Bear with me. How's that working?
Yes, that's fine. We can all see it. Thank you.
Okay. So as Tom said, this is a recap of the decisions we made at committee on the 5th of March. Those decisions were made off the back of a series of investment strategy workshops that we had. The presentation just recaps, it looks at the reasoning and reminds of the risks embedded in the investment strategy. And then I'll finish with a quick update on where we are with implementation. Much of that implementation was delegated to the officers and advisors to get on with. Okay, please, please stop and ask questions as we go. Hopefully that it'll work. So committee members that are here at March will be familiar with this table. I'll go through it a bit slowly for some of the new members. we started off by considering, how the pension scheme is funded. So there's a kind of basic reminder here that this is a defined benefit pension scheme. So those pension benefits are linked to salary, average salaries. It's not a defined contribution scheme where the benefits are uncertain and linked to effectively the amount you put in and the returns you get. They are known benefit payments effectively. It's open to accrual, so employees still working for council employers are still building up pensions. So this table is from Mercer, who are the fund's actuary. Every 3 years, effectively, they look at the amount of built up liabilities that you've got. They compare it with the assets and calculate how well funded you are, effectively the financial health of the pension scheme. They also calculate what they think the cost of that future accrual, those building up of pension benefits, should be. Looking at March 2019 on the left-hand side, you can see we had assets of just below 2 billion, and the actuary calculated a present value of the liabilities just above 2 billion. So there was a deficit. So the funding level was 94%. So you actually needed to make up, the assets needed to grow faster than the liabilities to make that up. How that was calculated, so the liability value, need to calculate, the liabilities go out many years into the future, so you need to calculate a present value of those. The actuary does that using discount rates, so the real discount rate for the past service. So real means after inflation. So they assumed a discount rate of CPI plus 1.85. So all those future cash flows, benefit payments, they discounted by CPI, which we expect to be about 2% plus 1.85 to come up with that just over 2 billion present value. They then have to determine what's the cost of future pensions that are accruing. And they use a slightly higher discount rate because they can be less prudent of CPI plus 2.25, which is effectively what the returns we expect on the investment strategy must achieve. Okay. The outcome from all that at the last valuation was that the future service rate was a payment of 16.6% of pensionable salary. Deficit repair contributions, because there's that 132 million deficit of 9 million. So total contributions of 48 million. So 9 million of that 48 is deficit repair, 39 million is the cost of future accrual. Okay. Roll forward to December and you can see the assets have increased. So the assets are now above 2 billion and broadly in line with the liabilities. So we've now got a negligible deficit, 6 million. So really good news. So everything kind of being equal, using the same discount rates, we've now got the deficit repair contributions towards the bottom lower, just 1 million, and total contributions lower because we've taken off those, reduced the need for deficit repair contributions. So that's kind of where we are now. And what the actuary will need to look at this and next in detail in March 2022. What the actuary also is showing on this table is what are some of the risks inherent in funding the pension scheme. One of those risks is an asset fall. So we've seen assets increase from 1.9 billion to 2.1 billion. Clearly, to get the investment returns we need, there is a risk that assets fall in value. And the example the actuary has shown here is a 10% fall. So in that scenario, assets fall by 10%. We're now back in that deficit place. The liabilities are bigger than the assets. We need to make that good. How we're going to make that good is a mixture of investment returns, but you'll see the deficit repair contributions have gone up to 17 million in this example. So total contributions by the council and other employers is 58 million. So that's one risk, the assets fall in value. The other risk that the actuary is highlighting is that their expectation of future returns is lower. So in this example, the impact is on that real discount rate, both past and future. And the actuaries shown here are an example of expected returns falling by 0.5 or 0.75. So using the 0.75 example as the more extreme example, the discount rate is lower. Therefore, even though the assets have done well in this example, the present value of the liabilities is higher, and we've got a deficit again. We've got to make that good. Furthermore, the future service rate is lower, and therefore the cost of future accrual, those new pensions coming, the new liabilities coming through from people working currently, is higher. So in that scenario, again, we've got higher costs. So though thinking about how the pension scheme is funded has led to, you know, the link with the investment strategy in terms of the returns we need and the risks we take, and it's defined our objectives. And one of the objectives that we've got is to try and minimize the volatility in those contributions, keep those contributions stable. So we don't want, and particularly we don't want them going up, do we? How we do that is actually we need to increase expected returns a little bit because future returns have fallen. The expectation of future returns has fallen. So we need to keep the returns up from the investment strategy. However, we need to balance that by managing investment risk because we don't want those assets to fall. So those are the objectives of the investment strategies. Any questions on that? Okay. So this is what we agreed, the asset allocation effectively to achieve those outcomes in terms of stable contributions, keeping returns up, managing risk. So effectively, this is the asset allocation. The majority of our assets, 50% of our assets, so about $1 billion, are invested in equities. So the key driver of keeping the returns up is investing in ownership of listed companies, mostly around the world. And you can see our expected return from investing in equities is about 6.2% per annum over 10 years. However, we expect there to be volatility around that. You're not going to get 6.2% per annum every year. What we're looking to manage risk, we're not just investing in equities. We also don't need that, you know, we don't need 6.2% per annum. We can invest in some other things, so to diversify. One of the key other diversifiers that we're investing in is absolute return. Justin referred to this earlier. This is things like hedge funds, insurance-linked securities, absolute return, bond funds that look to get returns from other sources than the markets, effectively the main markets like the equity and credit markets. We've actually slightly reduced from our previous strategy the amount we've got allocated to absolute return. You can see it's got slightly lower returns than equity, lower volatility, and the advantage of diversification, it's got a low correlation to equity, so it's not going to act in the same way. We invest in property. This has been an existing holding for some time. We are increasing our allocation to a liquid growth, those level 3, if you like, audit assets. These are private equity, infrastructure, you know, particularly increasing the allocation to infrastructure. These are the long-term, large physical assets that are kind of key to the economy. Things like ports, wind farms, airports, you know, electrical charging points is kind of thing for the future. So we're increasing our allocation to that because we want that one of the advantages of those type of asset classes, they've got relatively high returns. They are risky. You know, the high returns come with risk, but there's some degree of diversification, that lower correlation to equities. We're also investing in private credit or illiquid credit, which is lending directly to companies or property owners, and we get a pickup in return than we would if we were investing in the public markets. And we're coming out of our small allocation to gilts that, as you can see there, very, very low, 0 expected returns and some volatility. So not a particularly attractive asset class at this time. overall, from this strategy, we expect returns of about 3.7% per annum above inflation, so above those discount rates. But we bear in mind that there's a volatility expected with those returns. So volatility of 10.5%, 2 out of every 3 years, we expect to be within, the return to be up between 14.2 and -6.8. Another measure of risk that we've talked about is that value at risk. It's used by a lot of financial institutions. It's a measure of, on those 2 billion of assets, in that 1 in 20 kind of bad year, great, the financial crisis 2008 is some kind of example of that. How much could we expect to lose on the assets? And it's just below £500 million.
Louis, can I just ask a question?
Yes, Tom.
Just for clarification on the expected return, 3.7% above CPI liabilities, above the discount rate. Which discount rate is that? Is that the real discount rate in the future? Going back to the previous page of possibly 2.25, it would probably just be useful to members, just so we, have a numerical target in our heads.
Yeah, so the comparison, so it's above CPI. So the comparison is here, you've got the 2.25. So our expected return, best estimate, so it's 50% of outcomes could be better than that, 50% worse than that, is 3.7. The actuary is saying you need 2.25. So there's some prudence between our 3.7 and the actuary's 2.25. Is that okay, Tom?
Yeah, thanks very much. That does clarify things immensely.
Okay. The other thing I wanted to show you, which I wasn't able to show you in March, is one of the things we can do, that 493 million risk measure. Now, there's lots of different ways we can measure risk, but using that one as a methodology for measuring risk, we can attribute it. We can look at what is the key driver of that risk. Now, this is just purely investment risk. Let's remember that there are lots of other risks involved with running a pension fund. One of the really obvious ones is how long people live, longevity.
Louis, we've just got another question, please, from Simon.
Yeah, hi Louis. I just wanted to, for clarification, my clarification, that expected return on equities at 6.2%. Per annum. Is that capital growth or as well as dividend? Can you just give me a bit of enlightenment about what that actually means?
Yeah, so it's based on Aon's capital market assumptions, which we look at and update every quarter. Ultimately, yeah, it's based on the value of the shares that you own, which will be a mixture of capital growth and dividends. So the UK uses dividends are a big part of that. Other countries, dividends are far less. It's driven by things like there's underlying things. Company earnings ultimately will drive that, where you've got things like GDP growth, inflation, and so on that will go into that.
Yeah, thanks very much. I appreciate that.
Okay. What we're doing here is attributing that risk measure, that value at risk risk measure. I think the kind of two takeaways from here. One is we're diversifying, so we're investing in property, infrastructure, private equity, liquid credit, absolute return. We're diversifying away from equities. Equities are our core holding. That diversification actually gives us a benefit. You can see here those bars, they all add up. But actually, there's a shaded area in the total, 493, because there's a diversification benefit, because those risks, the risks of investing in absolute return and equities are different. And, they're going to go through periods where they do well and do badly, but those periods are not necessarily going to be too correlated. So there's a benefit. The risks don't just add up. The other thing to take away with it, which hopefully is no surprise, we've got 50% of our assets invested in equities. Equities are volatile. They go through periods where they, where there's quite major falls. We hope that we get those returns back through the long term. but it is our key risk. So it's just highlighting that, which hopefully we were aware of anyway. Okay. Any questions on the investment strategy before I move on to kind of implementation?
Chairman.
Okay.
Sorry, yes.
Yes, Brian.
I was trying to switch on. Louis, you made the statement that we're moving away from equities.
Sorry. I didn't mean that, Brian. I misspoke if I said that.
Because I thought we had agreed as a policy to retain at least 50%.
Yes, absolutely. Apologies that I didn't mean we were moving away from equities. So the changes to investment strategy are actually a slight increase in equities, a slight reduction in absolute return, a reduction in gilts, and a movement towards what I would call private markets, which is particularly infrastructure and illiquid credit. So no, we're not coming out of equities, Brian.
Well, moving away. Yeah.
Sorry, we're not moving away from equities.
Okay, thank you.
Apologies. Okay, in terms of implementation, so what we're showing here is a table showing the strategic allocation that we agreed in March. We're showing what the asset allocation actually was of the assets at 25th of May. And then I've got a little bit of an update on where we are. So you can actually see we've actually got more in equities at the moment than the strategy. However, as we know, a considerable part of those equities are protected by our options overlay, and we're going to be talking about that a little bit later. We also need to decide within equities, how we invest in equities. Is it active? Is it passive? Is it UK? Is it global? And all those considerations regarding responsible investment and climate, which we're going to come on to. So we need to do some work in terms of what that underlying equity allocation is. That is all to follow. In terms of, yes.
Can I just comment? Our strategic allocation is 50%. It used to be 47%, but we've moved it up to 50 at our last meeting. And I appreciate the actual level of equities at the moment is 51.6. That presumably is because we've done exceedingly well through equities in the last few months, and that they have increased in value. So the fact that they are now 51.6% is in a way a recognition of the great growth and increase in value that we've achieved through our equities. And it brings up a question, as we're doing so well, are we now talking about rebalancing and actually reducing back from 51 to 50%? And I guess the answer may well be yes. Whereas in fact, if we are doing so well, should we not let our equities run for the time being?
It's a good question. So I think you're absolutely right. It is due to equities performing well. I think it's also due that we actually haven't been rebalancing. So normally we would do a degree of rebalancing through time. We haven't been for two reasons. One is that we've been going through the strategy review. And the other is, we don't need to rebalance because we've actually got an equity protection, the options overlay over that. We also need to bear in mind that when the equity protection overlay ends, there may be some payments that need to be made. So that is something that we're keeping an eye on.
Chairman.
Yes, Brian.
If one was to reduce the equity allocation, we would of course have to make a decision as a committee to where we rebalanced upwards some of the other elements of our investment strategy. Would we put more into absolute return? Would we think more about property? A rebalancing exercise of any consequence really needs a strong committee discussion guided by our experts as to just how we rebalance. My own view is that we should let equities run for the time being. The increase is mainly, as we all know, the all share indexes and the FTSE have increased over the first 6 months of this year. It's anybody's view as to whether they will keep on increasing or whether there will be a setback. But I wouldn't want to do a rebalancing exercise possibly before the end of this calendar year, if not the end of the financial year. I'm happy to let equities run. I doubt if we're going to get up to 60% actual allocation, but for another couple of percentage points is good news, basically, as you have highlighted earlier on. So I'm quite happy with the situation to let equities run for the time being. Thank you.
Ryan, could I just add to that? I think I understand where you're coming from. We do actually, within our investment strategy statement, we have some rebalancing ranges around which effectively I think that the implementation of is delegated to the officers and advisors. I mean, this is quite a small overweight to equities, which will be well within those ranges. I also think we need to remember, so the big areas we are underweight and looking to invest are illiquid growth and illiquid credit. They will take some time to draw down. We won't be able to immediately move up to our strategic weight in those asset classes. So I think it highly likely that for a period we will be needing to invest elsewhere, and that will probably likely mean being overweight equities.
Thank you.
Thank you. Yes, James Walton would just like to come in, please.
Just really to pick up on that point, that obviously the thing that we've got to remember as a committee is that ultimately we have an investment strategy. And so one of the ironies of that, in a sense, is that if a particular sector, particular investment class is doing very, very well, then by definition we take money away from it. Because if we don't, we are out of balance with our investment strategy. And I suppose the point to remember here is that equities are a very volatile class, and should we let those equities run to a point where they're in excess of the parameters that we put around our investment strategy, and then there's a huge crash and we lose money on the back of that, then the question would be asked of the pensions committee, why did you step outside of your investment strategy? And the only answer could be that we thought better than the investment strategy, and we thought that we were going to make more money out of that. And that is not a good place to be in terms of protecting the committee. So while Louis is absolutely correct, while we have tolerances within that, and we can certainly look to, we don't need to be cutting that at a particular point in time. There are timing issues that we need to look at. We do need to be very careful and make sure that we stick to our investment strategy. And that's ultimately there to protect the pension fund and to protect the pensions committee.
Okay, thanks very much for that. And back to Louis, please.
So just to finish off on the things we're progressing. Sorry, one of the things I should have said earlier, all of this investment strategy previously, a few years ago, would have been implemented through fund managers selected by the committee. Going forward, this will be implemented by fund managers selected by an organisation called LGPS Central, which is a pool that was set up to implement for a group of LGPS funds, kind of all in your area, effectively. So a lot of these things, so absolute return, we have some investments in absolute return at the moment. We are now working with LGPS Central to help them build, select the managers effectively that will run that for you going forward. And there's an ongoing process involved there. Similarly with property, we've got our own manager. We're awaiting what LGPS Central are going to offer us there. Infrastructure, LGPS Central have recently set up a fund or a couple of funds. Aon have actually, we've now completed that process of reviewing it and have given the okay, so it will probably be left with the officers to implement that. Similarly, in private credit, we have reviewed and now we're good to invest with that. With gilts, one of the ways we will fund those new investments in infrastructure and private credit will be coming out of the gilts or LDI holdings. That is all for me in terms of the investment strategy and implementation update.
Okay, thank you very much indeed for that, Louis. It's very informative. Any further questions, members? Oh, yes, Roger.
I've got a question on the recommendations that will be put shortly. Do you want me to talk about it now, or is there anything to do with the report first?
I think that is the next paper, because this is just a presentation.
Okay.
Do you happen to know which agenda item your recommendations are on?
Yes, Chairman. Sorry, it's on 8 on the investment strategy.
Oh, that's the paper coming up next.
Okay, sorry.
So okay. Well, thanks for the presentation, and then we'll move now on to the pension fund strategy. Is that item 8? It's Justin. Yes. Over to Justin. Thank you.
9.
9. Yes.
That's the treasury strategy.
There we go. Justin.
Thank you, Chair. So this is the pension fund treasury strategy for 21-22. This relates to the small working cash balances that are managed by Shropshire Council. It's the administering authority for the pension fund, and it mirrors Shropshire Council's treasury strategy, which is agreed on an annual basis. This isn't anything to do with the 2.1 billion that we just talked about. That's all managed by external managers. This is to do with it's between £1 and £8 million that the internal treasury team at Shropshire here manage on behalf of the pension fund. And the investment priorities continue to be the security and the liquidity of those investments, and the cash balances are invested with highly credit rated institutions, the same as Shropshire Council's investments. And the pension fund cash is invested separately, so we need a separate treasury strategy approving. So the committee are just asked to approve the report and the recommendations, and I'm happy to take any further questions on the report.
Roger, do you want to? Is this the one you want to come in on?
Bear with me just a second. Where I'm coming from, Chairman, is the climate change and the investment in that. Now, I can talk about it here, or I can talk about it in a few minutes. It was whether the small amount, in relative terms, small amount, are we investing in any fossil fuel equities or anything like that? I'd like confirmation that we are not, even short-term, investing in any of those.
No, these are banks, highly credit rated banks.
Okay, so you're happy with that, Roger? Yeah. And Simon?
Yeah, just a quick question. The small thing, typo on, I suppose it's Svenska Handelsbank on page 27, but that wasn't really my point. Why are we using Svenska Handelsbank?
Because Svenska Handelsbank are one of the highest credit rated banks on the council's lending list at the moment. Obviously they're based in Sweden, but the sovereign rating of Sweden is AAA, so it's it's even higher than the UK. The rate, it's instant access, so we can get instant access to the cash, you can get it back immediately. But the rates that Svenska Handelsbank can pay are slightly better than some of the UK banks. So it's on the approved council lending list, which James, as Executive Director of Resources, approves each year on behalf of the council and the pension fund. So it's a highly secure investment, it's instant access, and it pays a good rate of return.
And that's in the London branch, is it?
It's a local branch, actually. There's branches in Shrewsbury, you've probably seen it, so it's a local branch in Shrewsbury, but there is a London branch as well, yes.
And just to confirm that local branch is a branch of the Swedish Svenska Handelsbank. There's no line drawn between them, so that can go down, but the Svenska Handelsbank in Sweden is quite allowed not to support it. You're comfortable with that?
Yeah.
Cool. Thank you very much, sir.
Okay, any other questions, please? No, well, in that case, we'll move on to the recommendations. There are 4 recommendations. 2.1, we're asked to delegate authority to the scheme administrator, section 151 officer, to manage the pension fund's day-to-day cash balances. 2.2, members are asked to approve with any comments the pension fund treasury strategy. 2.3, members are asked to authorise the scheme administrator, section 151 officer, to place deposits in accordance with the pension fund's treasury strategy. And 2.4, members are also asked to delegate authority to the scheme administrator, section 151 officer, to add and remove institutions from the approved lending list and amend cash and period limits as necessary in line with the administering authority's creditworthiness policy. May I have a proposer, please?
Yes, I will propose.
Thank you. And a seconder? Thank you. Everybody in favour? Yep. Okay. Thank you, Roger. In favour? Yep. Okay. Unanimous. Thank you very much. We'll now move on to the next item, which is item 10, corporate governance monitoring. And over to Justin again, please.
Okay, thank you, Chair. So this is the quarterly corporate governance report. So obviously existing pension committee members are very familiar with this. It's a routine report that we take each quarter. It just provides an update really on all it's to do with the responsible investment in ESG. It provides updates on all the manager voting that's taking place at annual meetings during the quarter. So we use a company called BMO that engage with all the companies that Shropshire County Pension Fund invests in, both UK and globally. It also provides an update on, Louis mentioned in his presentation, LGPS Central, about the responsible investment activities during the quarter they've undertaken. We've got 2 equity managers, a UK equity manager called Majedi. It's got all their voting attached to the appendixes, and also Legal and General, that is a passive fund we invest in. They invest in global companies, so it's got all the responsible investment activities and information attached as appendices to that report, just for information. Table, again, for the new members on the committee, if you look at table in paragraph 9.1 of the report on page 35 in the pack, that just highlights to date really the progress that we've made as a committee over the last 12 months following the council's motion to divest from fossil fuels, and the timeline in there for future decisions that the committee will be making. So again, for the new members, there's a lot of information, there's links to the council's website where we've had detailed discussions, detailed presentations on all these issues, so the new members can access those because they're held virtually and the meetings recorded. We've had specialist managers, the likes of BMO and Legal and General, and Majedi coming in to present to committee on climate change. So it's important that obviously the new members get up to speed, so all the links are highlighted within that report. At the next meeting in September, we've agreed as part of that process, we're going to be developing our own climate strategy for the pension fund and climate stewardship plan. That has been drafted now and it's due to be discussed with officers and advisors over the summer, and that'll be brought back to the September Pensions Committee for approval. Obviously there's a further training session later today as part of this agenda on responsible investment and climate risk options and considerations. So there'll be a further update later on in this meeting today for members. So as I say, it's a standard routine report that we produce every quarter. It's got a lot of information in there. It's a lot to take in. There's a lot of information in the appendices that just proves how seriously the pension fund take these issues. So I'm happy to take any questions on that report.
Roger.
Thank you, Chairman. Could have come up earlier on, but I think maybe this is the best place for it. I noticed in the recommendations, and I've also got a copy of the council decision that was made virtually 12 months ago. And the Shropshire Council decision was, as a policy, to disinvest from fossil fuel in 3 years. And they say in their first part of that motion they instruct the Chief Executive to write to the Pension Fund Committee asking the committee to follow best practice by, and item 1 says, adding a statement to their strategy that climate change constitutes financial risks to the fund. That's a Shropshire Council policy statement. I understand I'm here from Shropshire Council to manage the funds to get the best return for the pensioners past and future. I didn't make that statement at the part. I am a pensioner from Shropshire Council Fund. But that statement, I think, needs to be included in the recommendations because it is a policy of Shropshire Council that they wish that to be stated within it from their point of view, and also confirmation that we are making no further investments in any fossil fuel companies. Thank you.
James, yes.
Okay. Yeah, thanks, Roger. So we've discussed this a few times, obviously at the Pensions Committee. So Shropshire Council is one of the employers within the pension fund, and therefore can make recommendations, can make requests, as can Telford and Wrekin as the other large employer, and as can the other 150 or so employers within the scheme. There is then the question of what the members want as well as the employers, and all of that requires an extensive piece of work to be completed. So that piece of work is what we've been working through. The thing to bear in mind with this is that the request was made to divest from fossil fuels within 3 years, and there is a whole series of work that's been done on the back of that to understand whether that is the best option. And ultimately, the Pensions Committee is the ultimate decision maker in that, and has to be clear that it's making that decision with the best information that it has. For that reason, there's been extensive work, training, opportunities provided for Pension Committee members to get up to speed with that. There is a lot of previous work that is now available to be viewed, the recordings of previous meetings, chairs has made statements, we've had documentation. All of that needs to be taken into account. And then ultimately, by the end of this year, we're due to make a decision around this. Now, as part of that, that is about not just putting a statement in around climate change, but actually creating an entire climate change strategy. So climate change strategy is far more important because that's what we actually need to be taken into account as a pension fund. If just as a point of clarification, should the committee decide that it wished to divest from fossil fuels, and ultimately potentially could take that decision, the mechanics of doing that are not significant. We're not talking about taking a huge amount of time to do that. So we are confident that decisions taken later this year or even taken next year would still enable us to meet that requirement of dealing with it within 3 years, should that be necessary. But I think it's really important to ensure that, and to be fair, Roger, you've raised this in absolutely the correct way. You're here as a pension committee member, as a representative from Shropshire Council, but ultimately you'll be making decisions as a pension committee member, not as a Shropshire Council member, if that makes sense.
Okay, Roger?
If I can, Chairman, all I'm essentially asking is that the statement from Shropshire Council, and it's attributed to Shropshire Council, and that's only one constituent member of this committee, if I can use that word, but Shropshire Council, as a policy, said that they wanted a statement added to the strategy that climate change constitutes financial risks to the fund. Just a plain statement, Shropshire Council has made that statement, and surely that should, in the recommendation here, doesn't include Telford and Wrekin, doesn't include any other employer, but Shropshire Council, as a policy, has made that statement and wanted it included. That's where I'm coming from this.
Thank you. I think there's a few points within this, and it may be that Justin or Louis would be better to answer this question. But fundamentally, that constitutes one of the risks for the investment strategy for the fund as a whole, and we are absolutely cognizant of all of those risks. So to state that particular risk on the basis of one particular employer is in a sense unnecessary, on the basis that we fully understand the risks associated with this, and part of the job of the pension fund and the pensions committee is about absolutely managing risks across the whole piece, and one of those risks is a significant one, but it may not potentially even be the most significant. But the risks that we have include climate change already, and that's absolutely clear in the documentation that we have.
James, shall I add to that? Because last year, the pension fund produced a report which was a TCFD report, which is Task Force for Climate-Related Financial Disclosures. In that report, and there's some quotes in the presentation that I cover later, there is a very clear statement from the fund that I'll read it out word for word. The fund recognises the climate-related risks can be financially material, and that due consideration of climate risk falls within the scope of the fund's fiduciary duty. So I think that's a formal document for the Shropshire Pension Fund, where I think there is quite a high degree of recognition of the risk there.
Roger. Last time, Chairman. I pick up the word can be. Shropshire Council passed almost unanimously, I think there are only 2, maybe 3 abstentions from it, this policy statement. All I'm asking is that this policy statement, which is a sentence, and it is from Shropshire Council, none of the other constituent bodies have made it, but Shropshire Council asks that the statement be added to the strategy, and I could repeat those words again, and there is a recommendation before us today for this. Members are asked to accept the positions as stated out, but I'm asking that it be noted, if you wish, that Shropshire Council has made the following statement. Maybe not holds and not instructing anything, but it needs to be registered. That's where I'm coming from.
My own view, Roger, and we may disagree on this, is we are coming up to having a big decision later in the year, and I think actually this is appropriate for that particular debate. I don't want to get into the situation where we end up sort of ending into sort of predetermination territory. And we hear what you say, but I think that is perhaps for another day, and I think I'd be more comfortable if, when we have the debate, that's the time when we have the debate, rather than sort of potentially end up predetermining things. Yeah, okay.
But if I can, Chairman, I don't think I'll be getting a seconder on it, but I would like it noted that I have raised this on behalf of Shropshire Council members, that they wish this to be noted as a part of the strategy, and when it is looked at, it's a 3-year timescale, and I understand we need time to consider and how to do it. And you can't guess the future, but that's, and I would like it noted that that is there from Shropshire Council, and it needs to be considered.
Okay, well, as a member, you're quite entitled to ask that, and fair enough. Yeah. Okay, it's noted. Right. Are there any other questions? No. Well, in that case, that was item 10. We'll now move on to item 11, please. Pensions Administration Monitoring Report, and that's Debbie Sharp. Thank you, Debbie.
Thank you, Chair. This report updates all members with the monitoring information regarding the undertaking of the duties of the Pensions Administration team. There are 4 recommendations on this report at this committee: to note the report, to agree that we work with the scheme administrator on an increased budget for training, and to also approve, with or without comment, 2 policies: the employer's events policy and the funding strategy statement, all as appendices. The report, just want to bring to your attention the performance are around 4.2. All fund employers have submitted their final month 12 data submission, so we've got the data for all of the members across the scheme, so we're doing some checks on that data to identify any gaps or any anomalies. 4.3, as well as data collection, this time of year, what we're also doing is checking the reconciliations of the contributions we've received over the last 12 months from all employers against those that we've got in our accounts, and again asking employers to tell us if there are any anomalies and whether they need any adjustments. That's being worked on presently. Shropshire Council has announced that office-based working will cease going forward for a number of reasons. It's been in place and worked fairly successfully for the Pensions Administration team over the pandemic, so it's looking likely that it will be predominantly working from home going forward, with guests being able to be booked for staff when they need them. But obviously working from home is causing issues around online training, knowledge transfer, so there's already been identified a need for this, and that's where we're asking committee just to authorise that an increased spend due to us needing to buy some online training modules, and also look at knowledge hubs to make it far easier staff to gain or answer some of their questions. There's help desk statistics there at 5.1 for you, just showing the amount of queries that are running through our help desk team. At 6.2, communications and governance section, just to note that the employers meeting will take place at presently on the 22nd of November, and this will be an opportunity where the actuary will be coming to present to the employers on the initial thoughts regarding the next triennial valuation, and also what is the outcome of an interim fund valuation being looked at presently. We can also update employers at that point in time on the McLeod project. For new members of the committee, McLeod project is the underpin the age discrimination that has been brought against the public sector schemes, and we have got to have a new set of regulation changes which aren't known presently, but it just means that all of our data that the employers have been sending us since the change in regulations, we have to ensure we've got the data to calculate the benefits under the previous set of regulations as well. So there's a lot of information needed to be checked with our employers. Because of course a care scheme is just based on pay, whereas the final salary scheme we used to run up until 2014 is based on service and pay. So we have to ensure that we've now got all of the gaps filled in to ensure that we can run an underpin calculation. 6.5, just to point out there that the public sector now have public sector accessibility regulations that we have to follow for information that's on our website. Of course, our papers through committee are on the website as well. So we've started to have a look at our documentation. We've changed a lot of them that they are accessible for people who may need to use e-readers or different helpers for looking at information on the web. And we've changed the font and we've changed a few things just on my administration papers this time. So we're having a look at what we can change, and we're working with committee then for the rest of this financial year to see what else will change on the committee papers. But just to bring to your attention that on our website we've undertaken the training, and we're now ensuring that most of our documents are accessible and comply with the regulations. A bit further update on the ministerial statement on McLeod. They're presently at 9.2, 9.3, and just to say that the remedy isn't in regulations yet. There will be a consultation later this year. The key points of what it's expected to cover are there at 9.4, and we'll wait to see what comes out regarding that, but I'd already just mentioned at the moment we're ensuring our data is correct to do what we think we will need to do. Point 10, the employer flexibilities. that ties in with two of the recommendations. We've got some tweaks to our policy, the both appendices there, Appendix C of the employer events policy and Appendix D, the funding strategy statement. A bit difficult to say if you haven't got your teeth in. And they're tweaked to actually take on board the new powers that have been available to the administering authorities regarding reviewing employer contributions between valuations and providing more flexible termination strategies. So both of those policies have ensured that we can utilise those powers and work with employers where necessary when they're actually leaving the fund. And I'm happy to take any questions, Chair.
Thank you, Debbie. Any questions, please? No? Well, in that case, we'll move on to the recommendations. 2.1, members are asked to accept the position as set out in the report. 2.2, members are asked to agree that online training and information resource deemed necessary for working from home to be procured with agreement from the scheme administrator. 2.3, to approve with or without comment the revised employers events policy at Appendix C, and 2.4, to approve with or without comment the revised funding strategy statement at Appendix D. I'd like to propose that. May I have a seconder, please? Roger, all those in favour? Thank you very much. That concludes item 11. We now move on to item 12, to exclude the exclusion of press and public. And I would like to propose the motion to consider a resolution under paragraph 10.1 of the Council's access to information procedure rules that the proceedings of the committee in relation to the following agenda items shall not be conducted in public on the grounds that they involve the likely disclosure of exempt information as defined by the categories specified against them. I propose, can I have a seconder, please?
Yeah, I second that.
Seconder, all those in favour? Okay, thank you very much. So the press and public are now excluded or in the process.
I'll confirm when we've stopped talking.
Okay. What I suggest we do, we'll adjourn